DoorDash made $1.3 billion in gross profit last year. The people driving the food made less than $7 an hour after gas. That's not a bug in the algorithm, it's the product. If you've ever opened a gig app and done the math on what you actually took home versus what the app promised, you already know something is wrong. What we're going to do today is name the mechanism, because there is a specific engineering logic inside DoorDash's pay model, a kind of deliberately constructed illusion of freedom that explains why 7 million Americans are driving for a platform that is functionally incapable of paying them a living wage. We'll get to what that illusion is called, but first, let's establish exactly how bad the numbers are. According to a 2018 MIT study by Lawrence Katz and Alan Kruger, the median net hourly earnings for app-based delivery and rideshare workers, after vehicle expenses, fell below $10 per hour. Some cohorts averaged $3.37 an hour. That is below the federal minimum wage, and it is completely legal. Tony Hsu told Congress Dashers just want flexibility. Over 90% of them said so. DoorDash controls 67% of the U.S. food delivery market. That's not a platform, that's infrastructure. This company went public at $72 billion and had never turned a profit. Workers on Reddit are calling it chasing your own tail at 30 miles per hour. The EU just mandated reclassification. American regulators haven't moved. Prop 22 was the most expensive ballot campaign in California history, $224 million. Okay, so let's actually understand what DoorDash is, legally and structurally, before we get into how the mechanism works. DoorDash was founded in 2013 out of a Stanford dorm room. By 2024, it controls approximately 67% of the United States food delivery market by order volume, more than Uber Eats and Grubhub combined. That near-monopoly position matters because a driver who quits DoorDash doesn't have a comparable alternative. The next largest platform is half the size. The company has roughly 7 million active Dashers in the United States, according to its own SEC filings. And DoorDash's official advertised pay model is base pay plus promotions plus tips, with marketing materials historically promising $15 to $25 per hour. That figure is gross order revenue. It is revenue before mileage, fuel, vehicle depreciation, self-employment tax, and unpaid wait time are subtracted. Researchers at the Economic Policy Institute found the median effective net hourly rate for Dashers is closer to $7 to $9 an hour once all costs are accounted for, less than half the advertised ceiling. Now, here's the cost stack that DoorDash's earnings screen never shows you. The IRS standard mileage deduction in 2024 is 67 cents per mile. According to AAA's 2023 Your Driving Costs report, the true all-in cost of operating a mid-size sedan, including depreciation, insurance, maintenance, and fuel, averages 72.6 cents per mile. Every mile a Dasher drives costs more than the IRS allows them to deduct. Then there is the self-employment tax. Because Dashers are classified as independent contractors under the IRS IC rule and the Fair Labor Standards Act, they owe the full 15.3% self-employment tax on net earnings, both the employee side and the employer side of Social Security and Medicare. A W-2 employee pays 7.65%. A Dasher, grossing $30,000 per year, pays roughly $2,300 more in payroll taxes than an equivalent salaried worker earning the same amount. That hidden wage cut never appears on the earnings screen. And DoorDash avoids paying the employer side 7.65% FICA contribution on every dollar paid to drivers. The classification is not administrative. It is financial architecture. But here's the thing. The advertised pay rate and the cost stack are just the surface layer. There are three deeper mechanisms that explain why the math never works out, and the third one is the one that ties it all together. Chapter 1 is zone flooding. DoorDash segments cities into delivery zones and tracks real-time Dasher density inside each zone. The algorithm onboards more dashers than any given zone can support, creating a deliberate oversupply of labor. More dashers competing for the same orders mathematically suppresses per-order rates. This is not an accident. A Stanford economics working paper by Chen and Sheldon, updated in 2019, documented that platform labor oversupply is a deliberate equilibrium strategy, not a byproduct of growth. Think of it this way. Imagine if a staffing agency hired 4 times as many temps as it had shifts available, kept all 4 of them on call without pay, and then told investors it had a highly flexible workforce with low turnover risk. That is zone flooding. The flexibility DoorDash sells to workers is the exact same mechanism that ensures those workers can never accumulate enough consistent order volume to negotiate. You're too available to be scarce. Convenient. Chapter 2 is what we can call the hidden tip model. Between 2017 and 2019, DoorDash operated a pay structure in which customer tips were used to offset DoorDash's own base pay guarantee rather than stack on top of it. A customer left a $5 tip. The driver saw $5 in their earnings. But DoorDash had simply shifted $5 of its own cost obligation onto the customer's generosity. The driver received 0 additional income. The New York Times exposed this model in 2019. A class action settlement and FTC pressure forced DoorDash to pay $2.5 million to affected drivers in 2020 and to restructure the payout model. But here is what researchers at UC Berkeley's Labor Center found after the restructuring. Algorithmic pay adjustments on high-tip orders effectively claw back tip value through reduced base pay offers. The customer thinks they are tipping the worker. The algorithm has other plans. The underlying logic, minimizing marginal payout per order, was never turned off. It was just made less visible. Now, you might be thinking, surely drivers could just reject low-pay orders and wait for better ones, right? Sure. DoorDash's internal ranking system, the Dasher score, factors in acceptance rate, completion rate, and customer ratings to determine which drivers see the most lucrative orders first. A driver who declines low-paying orders is algorithmically deprioritized for high-paying ones. The algorithm does not punish you for saying no once. It punishes you across every future shift, making each individual refusal feel cheap, but making the cumulative cost of saying no enormous. Rationality is penalized. Compliance is rewarded with access. So we have zone flooding suppressing per-order rates. We have a tip model structured to minimize worker take-home, and we have a scoring system that punishes drivers for exercising the only leverage they theoretically have. These 3 mechanisms interlock into something with a specific name, and this is the point where we have to say it plainly. This is phantom flexibility. Phantom flexibility is the structural condition in which a platform worker is classified as an independent contractor, formally free to set their own hours and reject any order, while every algorithmic incentive is engineered to ensure they will keep working, never organize, and never break even. The flexibility is real in a narrow legal sense. You can log off. Nobody is stopping you. But the platform has built a cost structure where logging off costs you tomorrow's income, where saying no costs you next week's order queue, and where the sunk cost of the car you already bought and the gas you already spent keeps you chasing one more delivery past the point where the math works. According to the MIT and JPMorgan Chase Institute study from 2018, median gig platform earnings fall below minimum wage once costs are netted. The freedom is genuine. The trap is also genuine. Both things are true simultaneously, and that is the architecture. So, we have seen how zone flooding suppresses rates, how the tip model transfers cost to the worker, and how the Dasher score punishes rational refusal. All 3 converge into phantom flexibility, the illusion that you are your own boss, engineered precisely so you will never act like one. Now, in November 2020, California voters passed Proposition 22 after DoorDash, Uber, Lyft, and Instacart spent a combined $224 million on the campaign, the most expensive ballot initiative in California history. That spending was not philanthropic. It preserved a classification that saves the platforms an estimated $500 million per year in California labor costs alone. $224 million to protect $500 million annually. The return on lobbying is excellent. Economists at UC Berkeley estimated that reclassifying Dashers as employees would add $1.04 per order in labor costs. In 2021, DoorDash's gross profit margin was $1.03 per order. The company is, at its margin, one reclassification ruling away from a business model that does not exist. That's the number. Meanwhile, the EU's Platform Work Directive, passed in 2024, is forcing exactly this reclassification across European member states. When a regulator with actual jurisdiction acts, the economics surface immediately, and the economics are not kind to the current model. The FTC under Lina Khan flagged gig platform labor practices and cited what UC Law SF professor Veena Dubal has called algorithmic wage discrimination, the practice of using behavioral data to identify each worker's individual reservation wage and calibrate offers just above that floor. The algorithm doesn't set one price for labor, it sets a different price for every worker, using their own click history against them. The current FTC posture under the new administration is hands-off. The NLRA explicitly excludes independent contractors from unionization rights and collective bargaining protections, which means the same legal wall that saves DoorDash $500 million a year also makes it structurally impossible for drivers to organize the way a UPS delivery driver can. And 59 million Americans, roughly 36% of the United States workforce, according to the Bureau of Labor Statistics, now perform some form of gig or freelance work. If that workforce were a country, it would be the 24th largest employed population in the world, larger than South Korea's. None of them are covered by the NLRA. Tony Xu has repeatedly testified that over 90% of Dashers value flexibility above everything else. Critics, including economist Veena Dubal and Senator Bernie Sanders, have noted that the surveys producing that number never ask whether drivers would prefer flexibility and employment benefits. Asking the constrained preference question inside a constrained system and calling the result a revealed preference is, at minimum, a creative use of survey methodology. DoorDash is not really a delivery company. It is a labor arbitrage engine that sells workers the experience of independence while engineering the conditions of dependency. Phantom flexibility is now the operating template across the entire gig sector. Uber, Instacart, TaskRabbit all run recognizable variants of the same model. The question is not whether your gig platform is doing this. The question is whether the word employee will be allowed to mean anything in 10 years, or whether phantom flexibility becomes the permanent default classification for a third of the American workforce. If the EU's Platform Work Directive produces the data we expect, we'll have a much clearer answer. That follow-up is already in the queue.